at the most recent Federal Open Market Committee meeting, something happened that no financial journalist described with the weight it deserves. The Federal Reserve's new chair, Kevin Walsh, submitted no-dot-plot forecast. 17 other members of the committee, governors, regional Fed presidents, rotating voting members, submitted their projections for where interest rates are headed. Many of them predicted rate hikes, some predicted several. The implied probability of a rate increase at the July meeting went from 6% to 36% in a single week. Walsh said nothing. Where every specific historical track record in the world of central banking, where every word is parsed, every punctuation mark analyzed, and every deviation from precedent studied for weeks afterward, a Fed chair declining to submit a forecast at his first meeting is not a minor procedural detail, it is a signal. A very specific kind of signal with a very specific historical track record. And that track record is what this video is about. The dot plot, formerly called the Summary of Economic Projections, was introduced by Ben Bernanke in 2012 as a transparency tool. Each member of the Federal Open Market Committee submits an anonymous projection of where they believe the federal funds rate will be at the end of each of the next several years. These projections are then displayed as dots on a chart, hence the name. The aggregated dots give markets, businesses, and the public a picture of where Fed policymakers collectively believe rates are heading. The dot plot is not a promise. It is not a promise. It is not a promise. It is not a binding commitment. The primary mechanism by which the modern Federal Reserve communicates forward guidance. The expectation management tool that replaced, in the post-2008 era, the older practice of relying primarily on actual rate decisions to signal policy direction. In a financial system where trillions of dollars of contracts, mortgages, corporate debt, and government borrowing are priced off the anticipated path of short-term interest rates, the dot plot is not a bureaucratic formality. It is the instrument through which the central bank tells the world what money will cost in the future. When major institutions need to decide whether to lock in a future, when major institutions need to decide whether to lock in a fixed rate or load, whether to borrow short or long, whether to dot plot. A Fed chair who declines to participate in the dot plot is doing something structurally significant. He is removing the most authoritative voice, the chair's, from the primary forward guidance mechanism. He is telling markets, you will not know what I think rates should be, you will have to infer it from my actions. This is a specific philosophical approach to central banking that has historical precedent, and that precedent cuts both ways. To understand what Walsh's silence means, you need to understand the institution whose communication norms he is departing from, and how those norms were built over more than a century of contested monetary history. The Federal Reserve was created in 1913 following the Panic of 1915 as a response to the structural absence of a lender of last resort in the American financial system. The private banking system, without a central bank to provide liquidity in a crisis, had repeatedly generated financial panics in 1873, 1883, 1873, 1883, 1896, and finally 1970 that devastated the broader economy. But the Fed's creation was contested from the beginning. The core tension was political. A central bank with genuine independence to manage monetary policy without political interference would, by definition, sometimes make decisions that were economically necessary but politically painful. Raising interest rates slows the economy, increases unemployment, and reduces government's ability to borrow cheaply, consequences that elected officials and administrations consistently found inconvenient. The history of the Federal Reserve is, in large measure, the history of how this tension between monetary necessity and political convenience has been resolved at different moments, and what the consequences of different resolutions have been for inflation, economic stability, and ultimately the preservation or destruction of ordinary people's wealth. The first major resolution of this tension came not with the Fed's founding, but with the Treasury-Federal Reserve Accord of 1951. During World War II, the Fed had agreed to peg Treasury bond yields to buy whatever quantity of government bonds was necessary to keep yields from rising, effectively financing the war effort through monetary expansion regardless of the inflationary consequences. This arrangement persisted after the war, constraining the Fed's ability to fight the inflation that post-war spending and the Korean War were generating. The 1951 Accord, negotiated in direct confrontation with the Truman administration, which wanted the peg to continue, established the principle that the Federal Reserve had the independent authority to set monetary policy without being required to finance government spending. It was the founding document of modern Fed independence, and it came at a political cost. The Fed chair who negotiated it, Thomas McCabe, was effectively forced to resign under White House pressure within weeks of the accord signing, replaced by William McChesney Martin. Martin then served as Fed chair for 19 years, the longest tenure in Fed history, and established through those years the institutional culture of Fed independence that dominated American monetary policy for the next generation. His most famous articulation of that culture was also his most concise. The Fed's job, Martin said, was to take away the punch bowl just as the party gets going, to raise rates and slow the economy before inflation became entrenched, even when the administration and Congress wanted the party to continue. This was not popular. It was, however, effective. Inflation remained largely under control throughout Martin's tenure. Then came Arthur Burns. Burns was appointed Federal Reserve Chair by Richard Nixon in 1970. He was a distinguished economist, a Columbia professor, a former chairman of the Council of Economic Advisers, a man of genuine intellectual accomplishment. He was also, as subsequent historical evidence has made abundantly clear, deeply susceptible to political pressure from the administration that appointed him. The story of Burns and Nixon is the most thoroughly documented case study in modern history of what happens when a Fed chair allows political considerations to override monetary necessity. And the outcome, the great inflation of the 1970s, is the defining episode of middle-class wealth destruction in post-war American history, examined in detail in the fourth video of this series. The mechanism was simple and devastating. Nixon wanted low interest rates and an expanding economy heading into the 1972 presidential election. Burns, whose meetings with Nixon were later revealed through White House tapes to have been far more politically engaged than Fed chairs, should have been kept monetary policy looser than the underlying inflation dynamics required. The money supply grew, inflation rose, and when the 1973 oil shock added an external supply shock on top of already elevated inflation expectations, the combination produced the stagflation, high inflation plus slow growth, that destroyed the real wealth of American savers through most of the decade. Burns was not stupid, he understood at some level what was happening. But he consistently found reasons: the oil shock, supply-side factors, global commodity prices, to characterize inflation as something other than a monetary phenomenon requiring monetary tightening. He consistently yielded to political pressure at the moments when independent action was most needed. The historical record on Burns's tenure is unambiguous in its verdict. The politicization of monetary policy in the early 1970s was a primary cause of the worst inflation episode in post-war American history, and that inflation episode, as the historical record documented in this series, shows transferred wealth from ordinary savers and workers to asset owners on a scale that defined the economic experiences of an entire generation. Paul Volcker was appointed Fed chair by Jimmy Carter in 1979. Inheriting an economy in which inflation had become structurally embedded, where workers expected prices to rise and demanded wages accordingly, where businesses expected input costs to rise and priced accordingly, where inflation expectations had become self-fulfilling in a way that no incremental policy adjustment could break. Volcker's response was the most dramatic exercise of Federal Reserve independence in the institution's history. In October 1979, less than 2 months after taking office, he implemented what became known as the Saturday Night Massacre, a sharp increase in the federal funds rate target and a change in operating procedure that gave the Fed's open market desk much greater latitude to tighten money supply aggressively. Rates rose to 20%. The economy entered a severe recession. Unemployment reached nearly 11%. The political backlash was intense and bipartisan. Congressmen received 2x4 planks in the mail from construction workers who had lost their jobs because mortgage rates had made new construction impossible. Carter, who had appointed Volcker, lost the 1980 election partly on the economic devastation the tightening had created. Reagan won in 1985 and, to his historical credit, maintained Volcker's appointment despite the continuing economic pain. The tightening continued through eight and into 14 and then, as Volcker had always maintained it would, the inflation broke. Expectations reset. The self-fulfilling cycle of anticipated price increases was interrupted by the demonstrated willingness of the Federal Reserve to accept severe economic pain rather than yield to political pressure for easier money. The inflation of the Burns era, built over nearly a decade of monetary accommodation, was broken in approximately 3 years of brutal monetary discipline. But those 3 years required a Fed chair willing to accept political verification, severe recession, and mass unemployment as the price of restoring monetary credibility. Volcker's tenure established the template for what genuine Fed independence, exercised under conditions of real monetary stress, actually looks like: not comfortable, not popular, effective. Alan Greenspan, whose death was noted in the previous video, represented a third model of Fed independence, distinct from both Burns's politically compromised accommodation and Volcker's brutal rule-based tightening. Greenspan's approach, developed across his 18-and-a-half-year tenure from 1967 to 2006, relied primarily on communication, on the strategic management of market expectations through carefully crafted language that guided behavior without necessarily requiring dramatic rate movements. His congressional testimony became event studied by every major financial institution in the world. His famous comment about irrational exuberance in 1996 warning about potential asset price bubbles moved markets globally with two words. This communication-based approach to monetary policy was both a genuine innovation and a reflection of the specific conditions of the Greenspan era, the great moderation of low inflation, stable growth, and dollar dominance that made forward guidance a more powerful tool than it could have been in a more volatile environment. In a world where markets trusted the Fed's inflation commitment and where the structural tailwinds of globalization kept prices subdued, the Fed could guide the economy primarily through signals rather than actions. Ben Bernanke formalized and systematized this communication approach with the dot plot, formal inflation targeting, and the press conferences that Walsh's predecessor, Jerome Powell, continued and expanded. By the time Powell left office, the Fed's communication apparatus had become arguably as important. Walsh's dot plot abstention admits of three distinct historical interpretations, each with very different implications for the monetary trajectory ahead. The first interpretation is genuine data dependence. Walsh may be signaling, sincerely and without political motivation, that he believes the current economic environment is too uncertain for meaningful forward guidance, that with inflation at 4.2%, the Middle East conflict creating ongoing energy price uncertainty, and the labor market sending mixed signals pre-committing to a rate path would be less informative and potentially counterproductive. On this interpretation, his silence is a form of intellectual honesty. The honest answer to where are rates going is I don't know yet, and neither should you. This interpretation is consistent with Walsh's publicly stated views on central bank communication, which have long emphasized. The bond market, which, as this series has examined in detail, operates as the most accurate long-term assessor of monetary credibility, has already begun to price its interpretation of Walsh's silence. Treasury yields across the curve have remained elevated despite the recent partial easing of Strait of Hormuz shipping disruptions. The 30-year Treasury bond continues to price inflation expectations significantly above the Fed's 2% target, and the probability of a July rate hike, which jumped from 6% to 36% following the dot plot revelation, is itself a signal if the committee believes rates need to go higher, but the chair has not indicated his view. Markets are pricing uncertainty as a rate positive signal, because the most likely reason a new chair would abstain from the dot plot at the moment when his committee is hawkish is that he either agrees with the hawks or cannot yet commit to overriding them. This is the specific mechanism by which communication failures in monetary policy become self-reinforcing. When the primary communication channel produces ambiguity rather than clarity, markets fill the ambiguity with their own assumptions. Those assumptions, when priced into yields, affect the actual economic conditions, the Fed is trying to manage. Higher long-term yields slow investment, increase government borrowing costs, and add deflationary pressure to the real economy, even as the short-term inflation that prompted the hawkish committee views continues to be fed by energy prices and supply-side factors that interest rates cannot easily address. The bond market is, in other words, forcing a resolution that Walsh's silence was designed to defer. The longer the silence continues, the more the market will feel it, and the harder Walsh's eventual communication will have to work to recalibrate those market-formed expectations. The historical track record of Fed chair transitions at moments of genuine monetary stress produces a clear distribution of outcomes, even if the specific resolution in the current case remains uncertain. The Burns outcome, the new chair's silence or ambiguity, reflected genuine accommodation of political pressure. Monetary policy remained too loose for too long, and inflation became structurally embedded, requiring eventually the kind of painful correction that Volcker administered. This outcome has the worst consequences for ordinary savers and wage earners, the wealth destruction documented in this series' 4th and 8th videos. The Volcker outcome, the new chair's communication approach, however initially ambiguous, reflected genuine independence and the willingness to accept short-term economic pain for long-term monetary credibility. This outcome involves significant near-term disruption, recession, unemployment, asset price declines, but restores the monetary credibility that makes long-term wealth preservation possible. The Martin outcome, the new chair establishes a stable framework for independence under conditions that, while challenging, are manageable through consistent policy application. This is the most benign outcome, but also the rarest. It requires both genuine Fed independence and a degree of underlying economic stability that the current environment, with its debt burden and geopolitical pressures, makes more challenging to sustain than it was in Martin's era. Each of these historical outcomes produced a specific distribution of winners and losers in asset class terms. The Burns outcome destroyed bonds and cash, elevated hard assets and commodities. The Volcker outcome initially destroyed almost everything: stocks, bonds, real estate, gold. Before the restored credibility created the conditions for the great bull markets of the 1980s and 1990s. The Martin outcome generally rewarded patient, diversified investors across asset classes. Walsh's dot plot silence does not determine which of these outcomes follows. It does create the conditions under which markets, businesses, and individuals will need to navigate the coming months without the forward guidance that previous communication frameworks provided. And navigating without a map requires the kind of historical pattern recognition that this channel has spent 11 videos building. Kevin Walsh said nothing. And in central banking, saying nothing at a critical moment is itself a statement, one that history has learned, sometimes painfully, to interpret very carefully. The silence may be discipline, it may be strategy, it may be the early signal of something that only becomes clear in outcomes months or years from now. What the historical record establishes is that the question of Fed independence, of whether the central bank that manages the reserve currency's monetary policy operates on the basis of economic necessity or political convenience, is not a technical question about committee procedures. It is one of the most consequential questions in monetary history. The answers given by Burns and Volcker, by Martin and Greenspan, shaped the wealth and poverty of tens of millions of ordinary Americans across decades. Walsh's answer is still being written. The dot plot will eventually be filled in by action, if not by words. Subscribe, because this channel reads the signals before they become headlines.